What's the matter with you, Rock? Can't you see that I need you, Rock?
Oh my gosh.
The hell is that?
I don't know.
Sinnerman.
What is that?
The song Sinnerman? Whoa, Sinnerman, where you gonna run to? Sinnerman, where you gonna run to?
I don't know either, Jay. It's
Cinnamon?
okay.
Sinnerman. Sinnerman.
No, I like it better as cinnamon.
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there. Welcome to episode 60 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson's husband. And we pulled this off this week, guys. Like last week, we couldn't get AJ. We had to replace him at the last moment. We thought we were going to have to do it again. AJ was nowhere to be found. We thought he'd been kidnapped. And then he shows up with like black eyes. We're like, oh my God, what happened? But we got AJ back. He's live from Brazil, I'm assuming, or some closet somewhere. If you need help, blink twice. AJ, how's it going, buddy?
It's going good. My official statement for the government and the insurance companies is I have not been kidnapped at this time.
Do your captors provide you with Diet Coke?
Well, they had to provide me with Red Bull or there was going to be absolute mayhem. So.
Do you have a newspaper around to prove that today is whatever day it is today?
Hold up the date.
Well, we can narrow down his location based off the Red Bull can. I think they only make that Red Bull can in certain Dominican countries. So
they do.
We narrowed him down to a country.
Jay, how's it going, man?
It's going well. How are you doing?
I go last. Don't mess us up.
You asked me how I'm doing.
He's trying to be conversational.
I'm just being conversational. I'm doing great. I had a good day.
Did you give away one of those mugs or what? Did we do that last week?
We are giving away a mug. I'm not going to say who yet. People are going to have to stick around to the end of the show or later in the show at some point. But we are giving away a mug. We did a giveaway contest, and we have a winner, and I'll talk about it in a little while.
All right. Fair enough. A little touchy on that subject. Okay.
This is my second podcast with Mauricio today.
Ooh.
Anybody out there who wants to hear, like, just from the smart guys on this podcast, me and Mauricio,
go back to that old episode where AJ and I did it alone and we talked, and it's still like the fourth best.
Yeah, anybody that wants to hear from you two can listen to that. But anybody that wants to hear from the smart guys, Mauricio's Real Estate Syndicator Live today should be out in the next couple of days. Check it out.
That's awesome. Who's Mauricio doing it with?
The smart guy.
Are you drinking, Jay?
I have an excuse. I'm not drinking tonight. I have to give blood.
God.
I have to give blood in the morning. I have a doctor's appointment. I have to give blood. And so I'm sticking with coffee, no alcohol. Not that I probably could, but
it is never, you know how many times I've had to do blood surgery and stuff? They've never said no alcohol. It's just after midnight, nothing. So you could drink now and you could be fine.
Well, I'm choosing not to drink because I want to be sober for my blood work.
Sometime ask me about the time that in Russia sometime where I had to give blood and I didn't know I was going to do that in the morning. I thought it was just a physical, and we went out and got hammered the night before and we're up till 3 a.m. and they tried to take blood from me the next morning. It didn't go well. Mauricio, how's it going, man?
Just going great. Apparently the recession's been canceled, so I'm celebrating. It's all good. And
actually, you can't say that. AJ and I were talking and before about how the fact that our podcast does the best when we say there is bad news, there is a recession, or Trump's doing something. Those are the only two things. So don't let's say Trump, recession.
Trump. Yep, I was going to do that too. Trump. Maybe the SEO can kick in. Trump. No, but it's good. I took the day off yesterday. It was my daughter's birthday yesterday. I felt like it was my birthday. We went to sushi for lunch, and then we went to an arcade for the afternoon. I had a blast. I had a good time with my 8-year-old.
What's your game at the arcade? What do you play?
I like the games where you put the quarters in and they just kind of push all the quarters, so more quarters come down. That's my favorite.
Wait. Do you play the Willy Wonka one?
No, I literally play the one that you just put the coin in, it goes in there, and it's like, it was a nickel. It's all nickels, but it was a blast. We had a blast. But anyway, so I'm celebrating. So I bought the Pisco again, Kyle, just for you, a little Piscola. And because, the recession's been canceled, apparently. So yeah, just doing a little pisco to celebrate.
Fair enough. All right. I just had a really big dinner. We went to Pizzeria Uno. I'm feeling a little bloated, a little heavy. So I was like, what is something that's pretty light, low calorie, no carbs, no sugars? And so I went in my fridge, and like right up front, there was this it's this company called Clear, makes these RTDs, Clear rum. Anyway, so I thought I'd give it a try. Look pretty good.
Here's our giveaway this week. If anybody buys Clear, like a can of Clear, a bottle of Clear, and they post a picture of it on social media,
tag our actually we shouldn't tag our social media. There's no one. Tag Jay.
I will send you a Drunk Real Estate mug.
This is starting to get off the rail. This is absolutely ridiculous. AJ, we're going to put a stop to this. We're going to cancel the show. This is
Mauricio's already had too much time with Jay, so he's going to be super grumpy this whole episode. All right, so Mauricio kind of spoiled this a little bit, but we're going to talk about the recession being canceled because after the last CPI and jobs report, it was basically a given that we were heading for a recession. Volatility spiked, markets tanked, treasuries fell off a cliff. Well, a new week comes a new headline. So now Bank of America research is saying, not so fast. There's no recession on the way. So Jay, Jay is not handsome. Was this your typical overreaction, or is this still storm clouds ahead? So we make comments all the time about how we have this sheet. I know Mauricio and AJ don't go into it. So I write my little intro on this sheet, and Jay went in and changed it to, so Jay, you're really handsome. Was this your typical overreaction, or is it storm clouds ahead? And so luckily I'm not Ron Burgundy. I didn't just plow ahead right through it. So I got through.
I put it at 50-50. So yeah, I'm not saying the recession's canceled, but the Bank of America CEO, a guy I know. No, the Bank of America CEO came out and said the Bank of America research team. I have no idea what a Bank of America research team is, but apparently there are people in Bank of America who think they're smart and they do research, and they have said that they think we have achieved a soft landing and the chances at this point of a recession are basically zero. Now, I'm not sure that I agree with that. And basically, I'm opening this up to a discussion, but I pulled a few other headlines that may disagree with the Bank of America CEO. Obviously, we don't know
anytime anyone says the chances are zero, you should automatically not listen to them.
Well, I'll even go one further. Anytime anybody says the research team, you should probably skip. I'll tell you a funny story. So I was at an event. I think it was the Real Estate Guys event, but Jim Rickards was there. I don't know if you guys know Jim or heard of Jim. He wrote I don't know. He's a pretty well-known guy. He was making fun. He says basically the research department, all of these firms have it. So JP Morgan has one, Goldman Sachs. Everybody has a research department. But basically, like the main people just don't even pay attention to whatever they say. They'll come out with one position, but they'll actually trade on the complete opposite because like nobody really pays attention to the research team. But anyway,
yeah. Fun fact: if Ashley ever says our research team, that's just me.
So definitely don't trust it.
Yeah.
I want to bring up a chart. So just to start off this conversation, because I happened I happened to cross this chart today.
Wait, I'm confused. I thought we were going to do like 5 minutes of each headline, and you're like now on headline number 3, and you're crisscrossing. Like, what's going on here?
This actually isn't any of the headlines that I brought up. I just happened to
He's bringing a new one.
Yeah, and Mauricio, if you want to run the economic segment, you're welcome to step in.
I just finally went into this sheet, this famous document, this famous sheet you guys talk about, and there was a very structured process. And now Jay's coming in and like completely ignoring it.
Those are notes. And if you can't follow along, look, next time I'll write a script for you, Mauricio.
Mauricio's never showed up to anything with notes in his life, so this is completely foreign to him.
Okay, so what we're looking at here is a chart of basically credit card delinquency rates for Americans. And what we see on this chart is if we look at Q1 of 2024, the most recent quarter that's on here, we have a delinquency rate of 3.1%. If you go back through this chart, you'll see the last time we saw a delinquency rate over 3% or 3.1%, over 3%, was back in 2011. And so one of the things that we've seen, and this was actually, if you go back even just to 2021, beginning of 2022, before interest rates started going up, this was at an historic low, at least back as far as the chart goes back, which was 1990, at about 1.5%. And so since interest rates started to go up a couple of years ago, we've seen credit card delinquencies basically straight line up and to the right, and we're at a higher rate than we've been at any point since 2011. So that, to me, is a very telling fact. If you look at, and we can talk about other things as we go through, but you look at total household debt. Total household debt is now over $17 trillion. And what we've seen over the last couple years is that it used to be that every year debt would go up. That's pretty much a constant. But historically, what we've seen is that for the most part, the proportion of non-mortgage debt to mortgage debt has been about the same. So if somebody would have 75% mortgage debt and 25% non-mortgage debt, et cetera, what we've seen over the last couple of years is mortgage debt stayed pretty constant. People aren't getting new mortgages for higher interest rates, but the non-mortgage debt for the first time in history is really starting to expand. And so for the first time, people are taking on not just more debt, but a different type of debt. They're taking on more consumer debt. And so you couple that with the fact that we have higher delinquency rates on credit cards, on auto loans. We're seeing higher delinquency rates. To me, that's not a good sign of what's coming. It's basically telling me that we have a lot of people in this country that are struggling. So I'll let you guys jump in on that, but I've got more headlines I want to jump into.
Well, Jay, you know who else has a research department? Home Depot. And Home Depot research department is showing that for the first time, their customers are not deferring just because of higher financing costs, but because of greater uncertainty in the economy. So Home Depot is, I don't know who's more reliable, Bank of America's research team or Home Depot's research team, but Home Depot's telling us recession's on the way.
Yeah, and I'm a big believer that business data is a very good indicator of what's actually going on in the economy, better than any economist out there or any macroeconomic data. Listen to what the big businesses are saying. Mauricio, you were going to say something?
Well, I'm disoriented because I don't know where you're going with this, but let me address the credit card thing real quick. I actually was reading for the new, it must be slightly different stat, but I was reading that over the last year, I think it was a New York Fed, there's a 9% of all credit card balances had transitioned into delinquency over the last year. So that was an interesting stat. And yeah, credit cards basically doubled. I mean, you showed the chart, but when it kind of bottomed out in 2020, 2021, which is basically when the money started pouring in, there's about $750 billion of outstanding credit card debt from the American people. And today it's up to 1.14 trillion. And this is crazy. The average person carries a $6,300 balance, which I thought was really interesting. And as you guys know, credit card balances are obscene. It's like 20%. So, I mean, this is something that I've always been shocked at. You know, at some point, the credit cards, they're reaching their maximum. They've always gotten their savings accounts are coming down. So I just don't know how people are going to start continuing to, or actually going to be paying for a lot of the purchases. So I do anticipate this going to be affecting the sort of the purchasing thing. But I will also just address, going back to your Bank of America research department, other than making fun of them, they're in the minority, right? Like Jamie Dimon, I think, came out and just said, look, the most likely result here in his base case is still a recession. I think he's at 35% for this year.
And wasn't Jamie Dimon's base case 8% interest rates too? Like he gets quoted all the time, and then that kind of just doesn't, no one really follows up on his predictions. And then he just has, until he has a new quote.
Yeah, he basically said last week that the most likely outcome is a recession, 35% this year, up to 45% next year. The chances of a soft landing are only at 35%. And he's actually skeptical, as I am. He's probably been listening to the show. He's skeptical that inflation is going to get down all the way down to 2%. So because of that, and then Goldman Sachs also, they increased their recession from 15% probability to 25%. So Bank of America's research team seems to be in the minority in this one. And so anyway, but I thought it was an interesting headline too.
Well, let's talk about inflation, because I think if you look at the consumer debt, you look at credit card debt, you look at delinquency rates, that's all bad news. But We actually got some good news on inflation this morning. And when I say this morning, we're recording this Tuesday evening. So Tuesday morning, which is interesting because by the time this comes out on Wednesday morning, there'll be some more inflation information. CPI comes out on Wednesday morning. But on Tuesday morning, this morning, we saw the PPI data, which is basically the wholesale data. So inflation on wholesale goods, the goods that product manufacturers are seeing on their raw materials and things like that and the services that they use. And
was it good though, Jay?
What was that?
Was it good though? Because like I feel like we play this game all the time where like the media picks and chooses which headline they're going to use, and this headline they used was headline PPI. It was 0.1. We dropped year over year to 2.2. Yada yada yada. But then they kind of just didn't mention the fact that the core PPI wasn't as great, was it?
Yeah, so core PPI was actually up, and it's the highest it's been in a while. If you break down the data, what you'll see is that most categories actually saw disinflation, lower inflation for the month of June, because we're going back to June for this data. But the one area that saw high inflation was final demand goods. So basically, those raw materials that have already been kind of developed to some extent. I don't know exactly how they categorize this, which is certainly a big part of it. But if you looked at other areas like services, if you look at
sorry.
I'm still laughing about final demand goods. Like I just picture in my head like someone on their deathbed, or like, you know, they're on death row and like, what's your final demand? Like that's what I'm picturing.
I was wondering why you're laughing at that. Yeah. So I'm trying to remember, and I don't have the data in front of me. But long story short, if you looked at the core PPI categories, yeah, there's one category that was up 0.6% in June, which was a huge spike. But for the most part, most categories were down. The headline number, the PPI number, was 0.1%, taking the year-over-year number from 2.7% last month to 2.2% this month, which was a big move down. So PPI, by most measures, certainly not all measures, but by most measures, PPI came in actually really good this morning. So it'll be interesting to see when CPI comes out tomorrow. That I think that's going to be pretty telling. If we have a low number there, if we're still seeing, like last month, we saw negative 0.1% on the headline CPI number. If we see anything below 0.2%. I think that's going to be good.
The prediction's 0.2, right? Isn't it?
The prediction is, let me take a look. Yeah, the prediction is 0.2.
Right. So my question is, where is the freak out threshold? We know it's like, okay, below 0, that'll be a freak out threshold. But like if it's 0.1, if it's 0.4, like, because I feel like we're right on this, like everyone freaked out and then everyone was like, okay, let's calm down a little bit. It's not as bad as it seems. And then if we get like a 0.4 on the CPI, I feel like everyone's going to freak out again that, oh, we're going to have to cut interest rates, but inflation's not kicked, or we're going to see stagflation, like all this stuff. Like it's like we're like walking a tightrope right now.
Yeah, I think if we see anything over 0.2, if we see 0.3, that's going to be a bad number, because remember, monthly 0.3, if you annualize that, you multiply it by 12, that's 3.6%, which means the annual number is going up, and that's well above the 2% target. At 0.2%, annualized, that's 2.4, which is close enough to the 2% target that nobody's going to freak out. So yeah, I think this could be an important number. If it comes in high, it could change a lot of the calculus for the Fed come September. But assuming it comes in where it's anticipated or below that, it's going to be another data point that inflation is tamed at this point.
Can we just pray for a 0.2? Like, let's just, like, the volatility. What's the you're the VIX guy, Mauricio. What's your VIX level at right now? I follow the MOVE index, and the MOVE is still like over 120. So it's like volatility is still super high right now. That's why I'm saying, like, everyone's pins and needles waiting for something to happen.
Yeah, the VIX has come back down. I mean, it's back down. It's still higher than the baseline where it used to be in sort of the 12, 13. It spiked all the way up to 60 But now it's back down to like 18. I think today was 18. So it's still higher than it was, but it certainly is nowhere near what it was Monday, when we had that huge 1,000-point drop in the stock market. And that was something we pointed out last week in the show, that throughout all these other economic data that came out, VIX have been relatively data you would thought would have spooked the markets were not spooking the markets. And that didn't happen until Monday last week, but it's come down. It's come back down, but it's still, it's a good 50, 60% higher than the baseline has been over the last couple of years.
Is that what, did we figure out that yen carry trade, or is that still going on? We still got issues there.
I mean, that yen carry trade is not something that you just unwind or go back in like a matter of days. I mean, I actually saw a stat about it the other day, that they think that the whole carry trade is about $4 trillion. And that about a quarter of that, about 1.1 trillion, was what people had to come up with in order to cover their losses, in order to pay back those loans, because obviously there's all a bunch of loans. But the reason I think I think that was the reason why we came up with the recession to cancel, is that as soon as that happened on Monday, the Bank of Japan kind of started backpedaling a little bit. You remember last time we said, hey, they raised the rates it didn't seem like a lot, like from 0.1 to 0.25, but that's a huge move for most, people are taking out loans at huge leverages. And they had indicated that possibly they were going to continue to raise rates, and they backed off that immediately. Like as soon as the market, the yen stock market was taking a hit, everything was taking a hit in Japan. They basically came out and said, "Oh, we can't keep raising rates because of the market, and we can't be like whatever." So they've backtracked a little bit. The yen has kind of started to lose again a little bit. It rebounded, which is one of the issues that happened, but now it's kind of coming down a little bit more. Interestingly enough, the 10-year has also been, the yields on the 10-year have continued to go down a little bit, which means people are actually buying that, which would, some would indicate it's an indication of people being concerned that they're actually moving their money to the bonds. But the
10-year is weird, right? Like I feel like, because we really pay attention to it, and anyone who's in real estate with mortgage rates and stuff is going to really pay attention to it. And it nosedived there, and it was below 3.8 there. And then it jumped right back up, and it actually touched 4, and then came right back down, and now it's back below 3.9. It's 3.85 or something. So it's like there's not a lot of volatility in the markets, but right now with that 10-year treasury, it's sure all over the place.
Yeah, and don't forget, gold also is hitting again. It hit 2,500. It's an all-time high. It's really, again, that's you would think that people are moving towards gold. People are moving towards treasuries when they're concerned. They got fears. They don't want to put in anything too risky. So what's the most conservative, safe, quote unquote, safest investment out there? It's usually treasuries, right? 10-year bonds are as good as gold, and gold is at an all-time high. So people are moving their monies to conservative things, which could be argued as people are getting concerned.
We were talking a few minutes ago about the yen carry trade unwind, and just to address that a little more, I was in the Mauricio camp of, okay, this is done and over with, no longer a concern. The Bank of Japan decided not to raise rates. I saw some headlines the end of last week, beginning of this week, that like 50% of the carry had been unwound, 70% of the carry had been unwound, 90% of the carry had been unwound. And I thought it was interesting that nobody could really coalesce on how much money is out there, how much money has been borrowed from the Japanese Fed and been put into overseas markets like ours. And nobody has any idea of how much now has been taken out of our markets. And it's interesting that data seems to be pretty difficult to come by. But one thing I will point out is, the Bank of Japan has decided not to raise rates. So there's less of a concern that the borrowers of the yen are going to get squeezed from that side. But there's still other risks. So if the Fed drops rates here, or if the 10-year drops here, then that arbitrage is decreased. Or if the yen to dollar strength, if the yen gets stronger compared to the dollar, then the arbitrage amount gets squeezed there. So there are other places that this arbitrage can get squeezed. And so while I know earlier in the week or end of last week, a lot of people were kind of saying, okay, this carry trade thing is no longer a big issue short term. Now I'm starting to hear rumblings that it may still be a big issue, and people may have no idea how much money is out there or how much damage it could do to the markets if we see an event like we saw last week, but bigger.
Fair enough. Anything else we should be worried about?
Yeah, we should need to be looking at unemployment rates because inflation is going to be correlated directly with theirs. We had the I find it really interesting because although unemployment jumped for May, June layoffs were the lowest of the year. So it nosedived. The amount of people being laid off, everything else like that, just tanked in June. And I mean, compared to considering May was the highest layoffs of this year, I mean, maybe I guess it was right on par with February, but June is the lowest we've seen by far. I mean, it's 50% lower than the next lowest. That was really surprising to me. I thought with a jump up in unemployment, we may be hitting because unemployment has gone up every single month, right? Like, I mean, clockwork, just click, 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 click. So the lack of layoffs and seeing that low that we hit in June, that surprised me. I did not expect that. And that'll be interesting how that plays out if we've hit more of a stabilization in the unemployment number and the unemployment, instead of keep going up, remains fixed. And that's going to correlate a lot with how the Fed is going to look at those CPI numbers. If you had inflation drop down to 2.4 or 2.3, get closer to 2, and you had unemployment clicking up still, that is really, really different than if you have a stable employment or even a lowering, like an increase in employment and it getting to a 2.4. The difference to the Fed's a lot, right? So I think that to understand the Fed's actions, especially with inflation, they're going to be really looking at unemployment. If we do have unemployment keep jumping up, I think that will dramatically change the outlook of how they view inflation and what inflation will mean to the United States. And I think that's going to be, if it hovers under 5, it's a very different story than if it goes above 5.
Yeah, I think unemployment is definitely the biggest thing we need to be looking at and following these days. We don't have a lot of interesting data other than the jobless claims that we get every Thursday. We don't have a lot of interesting data there until next month. But certainly we need to look at. Now, speaking of data, there is a lot of data coming out this week that's worth keeping an eye on. So I mentioned CPI is tomorrow, which is huge. Thursday, we have manufacturing survey data, basically giving an idea of how manufacturing's going. We also have retail sales on Thursday, which is going to be a big one, basically telling us are people still spending money. And then on Friday, we have some real estate data. We have housing starts, building permits. We have home builder confidence on Friday. So this is going to be a pretty big week for data. And last thing I'll say is, speaking of real estate, since this is a real estate show, another headline that came out that I saw was that last month, 47 out of 50 states in the last year have seen an increase in the number of price drops on their listings. So single family homes. So it looks like we're starting to see, even though we're not seeing a ton of lower values, although they also talked about lower values, we're seeing values drop for the first time. But we're also seeing a lot of price drops. We're seeing transaction volume starting to increase. So it looks like we're starting to see the first signs that real estate is softening. And again, we've talked about this. I don't think any of us think that there's a major correction coming. I certainly don't. But I don't think it would surprise any of us, to speak for you guys, if you don't mind, that real estate may soften a little bit. And I think we're starting to see the first signs of that. Maybe it's seasonal, maybe it's the summer, maybe it's temporary, but we are starting to see some signs of softening in the single family market.
And while we do have that jobs reports coming out before the next Fed meeting, so between CPI and the jobs report, at this point, who knows? So we will definitely talk about the economy again once that comes out, and probably again next week after we get this CPI tomorrow. We're ready to move on?
Let's do it.
Well, we got AJ back and we were grumpy with him. So we're like, AJ, we need a self-storage update from you, buddy. Like, that's like, if there's one thing you're just going to show up straight from the closet you're being held in the middle of Central America somewhere, and you're still going to be able to talk about it, self-storage. So AJ, we've missed you. Tell us what's going on with self-storage.
Yeah, it's very interesting because this self-storage, you want to know more about the housing market, look at self-storage. The correlation between occupancy, move-in rates, and move-outs are directly correlated to the housing market. And we can see this very much in the spring. So self-storage boomed in the early spring. And that was right when housing transactions went really high. Now, after that, we saw demand really peter off during the busy season. It wasn't nearly as strong. We had a couple months that were really, really gangbusters, and then demand started to peter off. Now, over the last 2 years, self-storage has been going through a contraction driven through the housing market and due to interest rates. Now, there's two sides of this market. Like any market, we have the intrinsic value and extrinsic value. The extrinsic value means what's the asset trading on. And I got to make sure every time we talk about this, it seems like people can be talking about the same or talking about numbers, but they're talking about two totally different things. As in, so if asset values went down, that means the self-storage market's doing bad. Whereas operators may be saying, no, it's doing good because occupancy and revenue is up, right? So the extrinsic value means the assets traded on the market. We're seeing softening there finally. And that's just a realignment with interest rates and people being willing to accept that cap rates have gone up and that sellers have to sell. They're going to sell now, and they have to be more aligned with market expectations. I still, to this day, have not seen anything trade at what they went out to the market for. So anything that went out to the market was trading lower than what they went to the market for. Lots of times it's substantially lower. They're going out at a 5 cap and it's trading at a 7, right? Now, that is the asset market. When you look at the self-storage market, the actual industry itself, we've definitely seen a plateau in the bottom that happened last year. This spring was good. And the bottom wasn't nearly as low. Occupancy didn't drop during our slow season like it did the year before. And this busy season, we saw occupancy rates and everything rise more. This had a lot more to do with the readjustment in rates, current occupancy, more fill up of vacant facilities that had just come onto the market. And it had to do with the housing market, seeing that spurt and moving in the fall, early spring. So the overall self-storage market has what I would call leveled out from the bottoms of the different lows that it had been in. Like all asset classes, there's been this adjustment period. Self-storage was interesting on its adjustment with the consumer demand, not just that asset price, and having to readjust from a housing market that went from booming to stagnant. And self-storage is a very durable asset, high margins, great cash flow. So overall, it's the lowest defaulting asset of any commercial asset. We're not seeing defaults. We don't expect to see defaults like you do in office or any. The next lowest one is multifamily, and even for multifamily, storage.
Is that because of the health of the market, or is that because I know historically self-storage gets lower leverage on their loans? You're not talking about, the 80 LTVs, 75 LTVs that you're seeing in multifamily. You're seeing closer to like 50, right? So that would make it a little bit more resilient.
We get 70. That's about our LTV, 70. And really it's due to our margins. We have super high margins compared to other real estate asset classes.
When you say we, you mean the industry or just you because you're awesome?
No, definitely storage. I mean, that too, but definitely storage. So the industry has much higher margins than other asset classes. And we have a lot more things that I think that we can do to affect our margins than other asset classes do. And so we can adjust rents immediately. And we can fill up and move around there. Like our occupancies can go up and down, our revenues can very quickly. And so it gives us, it's much easier for us to adjust in real time to economic conditions. So when we saw the boom in the spring for 2 months, everybody doubled their marketing spend and sucked up all the demand. And then as it plateaued, rose prices on the people they'd just gotten in, lifting up revenues very quickly. And so there's that pretty good hedge against it. And so defaulting and waves of defaults, we just don't, I can't see it coming. Where you're going to see the adjustment is the asset trading and its price. So many people held off wanting to get those lower cap rates that were associated with lower interest rates that are realizing that's not coming. We're not getting that. Even if interest rates go down, they're not going down to anything in the realm of what they were. And if you have interest rates that go down a point, that doesn't necessarily mean the cap rates will come, with it. So you have a lot of sellers that are forced to sell for a whole variety of reasons. And so they're going to the market, and then that is becoming new comparables, new comps, and giving people more an idea of where things are trading at. It's setting a new version of normal, so to speak. And that takes time too. And so that really has happened this year.
Can you give a general idea, just for those who aren't in the asset class, including myself, cap rates? I mean, how much of an expansion have we seen since, I guess, the last 2 years since interest rates started going up?
So in first tier markets, major markets that most of us and people listening probably do not play in, probably about 100 point spread. So you probably went from a 4 to a 5, right? Now, that is select markets that most people are in. When you get outside that, if you're in other markets that are more second, third tier markets that generally most people play in, funds, people that are raising capital, things like that, you see more of a 200 to 300 basis point spread.
Wow.
And outside that, you have a definite 300 basis point spread. So they went from 5 to 7s. That's probably 5.
So like a tertiary market like Boise, Idaho.
Yeah, tertiary market. Well, if it's growing, though, at the rate it's growing, that's going to depend a lot. So Boise, Idaho, we haven't seen nearly as much, even though it needs it. And so all that means is product doesn't move. So when you have sellers that aren't willing to sell, if you have a seller in Boise, Idaho that still wants to sell at a 5 cap, it's not worth it. Nobody's buying it.
Well, what I found was so interesting with the self-storage, and I'll have to admit, all of my information usually comes from the fact that I watch Yardi Matrix's updates, and they've recently taken on self-storage. So they do apartments and self-storage. So I just hang around when they start talking about self-storage. But what I found interesting about self-storage is you guys also, your development cycle is much shorter, right? So like when you start to see softening in your market, like you guys can turn off that pipeline a lot quicker than we can. Like when we're, because the regulations and the red tape and everything, the whole process of developing multifamily is such a longer process that kind of like you hit that threshold of like the point of no return, and like you can't really turn that off easy, and like you'll still be a year from delivery, and things will be going wrong, and you're like, okay, we're in this ride, like we can't shut down now. Versus it seems like self-storage, like if you start to see softness in a market, you could kind of just be like, well, let's just leave it, we're not going to do it right now.
And two, the banks are more fickle with storage. So with storage, the banks will turn the money off faster. It's a shorter cycle. It's not as much capital. So the economics of it, everything else is different. So banks will turn the faucets off faster. The problem, though, you can get into self-storage is because it's lower capital, you have lower barriers of entry, so you have more people that will do dumb things, right? Like you have somebody that'll get $2 to $3 million in cash and build, no matter what anybody says. And so you do have that.
I'm on the west coast of Florida, and the amount of self-storage that I've seen go in, like in my area over the last year and a half, is just unbelievable. And I've seen places that have broken ground and they put up signs. So we see it's self-storage coming. And my wife and I drive by and say, there's no way they're going to build this out. Like there's so much inventory out there. We just moved to a new self-storage place because they offered us essentially a full year for the price of 2 months. Like we literally paid 2 months and they gave us a year. But yet they're still continuing to build. And so are we an anomaly, or is there still a lot of development going on despite the fact that it appears there's oversupply and there's expanding cap rates?
No, the money trying to get into self-storage is unreal. So you have, over the last 3 years, you've had a major shift from multifamily into storage, especially during COVID. And that we have seen in office. We've seen you have so many people that are like, I just threw in the towel. This is too much. I'm going into storage. And so there's a lot of capital that wants to get into storage. There's a lot of capital or a lot of people that are trying to get into storage to deploy capital. And so storage is still, as far as investors look, everything else like that, it's hot. Because if you think you're going into a recession, you actually want to be in storage. So all of a sudden, it creates this weird environment where you have demand for the asset that is more than demand from the consumers. Investors want it more than consumers need to use it. That's a problem, right? So it's been something we've talked about a while, and I've always been shocked when you talk to people because you ask, what did the market study that you did? Like, what did it look like? Right. So the market study, the analysis, it's just really, it's nothing. Like, it's like I had the land or I was going to build this, but I mean, storage seems to be doing great. There's no data behind it. There's no analysis. It's just, they just went to build it. Now, banks are supposed to be the ones that put a kibosh on that. But what we find there's certain markets where people will build because what they want to do is just get market share. In development, a lot of time, it's whoever develops first gets the territory, right? So it's like, it's a race to development. So you may have an area that has 5 potential properties, and it's like everybody's trying to get that property up before it gets oversupplied. But then a lot of them don't even know. So I'm putting my property up. I don't even know that one's coming in a mile and a half down the road, and it's under construction. So the lower barriers of entry cause a problem with certain players that don't come into it, and it's just easier to do. And so they're not as skilled. They don't understand the market as well. And they read stupid headlines like it's recession proof, which is not true. And then you get people that make bad decisions. And that's what we see in storage. So micro storage is a lot easier to be overbuilt. And there's certain markets that people like in Florida and others, they will buy with a much longer time frame. So they will say this market's growing. It's going to continue to grow. Even if we have a bad couple of years, we're going to do it. And they have a belief that we'll fill up while others won't or whatever. So that does tend to happen in storage. There's another problem that you can have really low occupancy in storage and still break even. So if you can do that, then you're like, I only have to fill up 300 units. I can do that, right? And if it's 200, we're okay. And so it does allow for that. Now, what happens is as they get overbuilt, as people are sucking pond water failing, then you need people to fail. Like the market actually needs people to fail. Because if someone doesn't fail, the system doesn't think there's anything wrong. And so the system keeps perpetuating itself. But the moment that somebody goes bankrupt, all the banks know. Everybody knows. And then everybody starts to say, don't do that. Until that happens, though, I always joke, because it's not a joke, though. You give developers money and they'll develop. It doesn't matter. If you give them money, they're just going to develop things. Whether there's a need or not, doesn't matter. They're just going to do it, right? They don't care. They just build. And they'll build until somebody stops giving them money. If a bank gives a developer money, they build. So it's got to, you need that contraction to start happening. I think it's happening because we've seen construction slow down, but there's still pockets that will absolutely be overbuilt.
Hey, Jay, is the majority of the demand coming from just population growth and cities growing, or is how much of it is just from baby boomers retiring and downgrading, or just people getting away from the huge McMansions and going from 8,000 square feet to 3,000 square feet and they got all this extra time? Is there a clear winner there, or is it just half and half?
Millennials are the largest user of storage of any generation by far. Millennials use the most storage, hands down. What we see is, Jay, if I'm guessing your area of Florida has a lot of HOAs. Yeah. So HOAs are huge drivers of self-storage. So you can get, if you have an area that is very densely new neighborhoods that all have HOAs, you will have a much higher rate of storage use. So regulation and the cost to build is what drives storage demand outside moving. Because what storage is turned into in America is I can pay how much a month or a year for a storage unit, but if I built that onto my house, how much would it cost? The spread's huge. Or I can't. It doesn't even matter. I have to buy a new home. You're not buying a new home right now. So the storage unit becomes the extension of our home, literally. It's a new garage.
So is that like an extension of the affordability issue then? Is this literally, I can't afford to build a bigger house or get a bigger house, and so this is a cheaper alternative for me to get more square footage to my house? It sounds like it's part of the affordability story.
It is. And it's also, too, when you have like regulation, you want a car, you can't put it out. Trailers, campers, you can't put it out. You want to build a shop on the side of your house or add that extension and a new bedroom onto your home. Neighborhood's like, no, you can't. And so then they're like, I don't have a choice, right? So regulation and the spread between the cost to build, add on, or the cost to move versus rent, those are the drivers besides moving. Moving's the biggest driver by far.
So where would you say you guys are in the cycle right now? Like, are you just in a holding pattern waiting for transactions to bump up, or is it like on the way down, way up? Where would you say it is?
I think we're coming out of a bottom. I think this is probably a contraction. We're coming out of it. Where you will see, though, the bottom go deeper is in areas like Jay's talked about. Because we plateaued, but in areas where they're putting new inventory out, we're not seeing increases of demand. So that new inventory is just going to easily saturate the market, right? And the only thing that'll stop that is interest rates lowering and the housing market picking up, which a lot of people are betting on. And then that will boost storage demand. If that doesn't happen, you have a lot of new storage facilities that don't have a lot of new customers sitting out open, and those markets will continue to contract. Rates will continue to fall in those markets. Other than that, markets that don't have a ton of new supply, we've hit kind of the downward cycle in both rates and occupancies, and we've stabilized that out. Over the next 2 years, they will be coming up. We'll see a rise in both occupancy and rates in markets that are not oversupplied with new storage facilities.
So I know we have a lot of both active self-storage operators in our audience and LPs, people that invest passively in a lot of things, including self-storage. So let's give advice to each of them. So for anybody out there that's either in self-storage, looking to get into self-storage, what should they be looking to do to be successful, and what should they avoid doing at this point in the cycle?
So at this point in the cycle, you need to take on a philosophy that has been our philosophy since we started our company. The market doesn't make us, but the market will kill us at any time. Meaning self-storage is not a real estate asset that you buy and the market makes rates go up and occupancy go up because the market goes up. If that is your plan and self-storage you think is an easier asset to run because there's no toilets, you will fail. Self-storage is an operating business. So storage facilities perform wildly different than one right across the street. We use dynamic pricing, revenue management. Our tech stacks are very heavy. The acquisition of new customers online is everything. I can have one facility that I can totally change its demand just by operating. So a lot of people have weak demand, but that's only because your customers can't find you. And so I think the first thing you need to realize is that the storage game is an operations game. And if you do not have an operator that is long-term in the industry, experienced operating, things like that, you can run into problems because the market's not going to make you, right? We're not in that market cycle. We were for 5-6 years where occupancies rates just always went up, right? That's done. That's over. We're back
cap
into
rates went
how
down.
It used to be. And cap rates went down. That's not happening anymore. And you shouldn't expect it to. Now, when you're looking at the overall market and investing in it, so if you're an LP, right, getting into it, if you're not an LP, you're looking at, okay, I want to buy, I want to operate, manage. Today's a great time to get in it because cap rates have gone up. And there's a lot of people that are struggling for reasons that they shouldn't be struggling. So you can buy them and turn them around. That's what we do, right? That's actually better during these times. It's better to buy things today than it was 3 years ago, even though the market looked like it was doing great. There's way more opportunity in upside and wealth creation and income today than there was 3 years ago, by far.
So wait a second. So you're saying that it's better to buy low and sell high?
I know, it's crazy. So I heard a guy say that in a book once. What was his name? Warren Buffett? I can't remember. But, it seems like it's a funky philosophy that will work. So we try that.
Okay. And for those for the LPs, so those who are looking at deals that are reading through PPMs and business plans and saying
nobody reads the PPMs, Jay. Come on.
Okay, well let's pretend somebody is reading through a PPM at some point and they're trying to decide, is this a deal I should invest in? What are the right questions to be asking and thinking about these days?
So I always ask a few things. First of all, where's your return coming from? And what that means is when they say, if people think, well, the asset. Well, that's not necessarily true. So returns can come from a few ways, 3 main ways: cash flow, refinance, or a sell. If your returns are coming from a sell, you should ask, who is the person that's going to buy this and at what price is that put in? Meaning that if you are buying this at a 5 cap and you think someone's going to buy it at a 4 cap, you're probably going to be way, way disappointed if that is where the return is coming from. Even if you're buying it at a 6 or a 7 and you think you're going to sell it for a 5, why? Do you think the market's going to magically get better? Because if so, that's fine. But you just need to realize that what you're betting on, so to speak, in that case. So if it's in a refinance, how's that revenue going to increase? Once again, is it the market or is there a business plan associated with this? What are they going to do? How's that going to increase to get that spread?
Real estate always goes up, AJ.
Real estate always goes up, baby. So, and then if it's cash flow, what are your margins? What are they today? How is the cash flow going to increase? And with all of them, I'd be asking, what happens if that doesn't occur? So I'd be looking in depth at that. And I'd look in depth at competition, but mainly you're vetting the operators that are doing it and the people that are putting it together. Self-storage is not like other real estate asset classes. It's just not. And so you need to really look at the people they're putting it on and where are they buying? Have they done this before? And when, where, how, all those questions, you're going to vet those operators in the asset class and how they will perform within it. That's really what you're going to do. Because at the end of the day, in syndications, yes, it's the asset class, but really you're trusting the operators and the people putting it together. And you need to ask what happens when things go wrong. Because they do, like we've all seen in the last 3 years. We had business plans that we had to scratch and throw out. And that's part of it, right? But sometimes the operators don't have a plan or can't handle that. The answer is no, it's okay because the market will go up. Or this is a low defaulting asset class. Very bad answers to get from somebody, especially in today's market.
Well, I threw this up a little bit earlier where AJ was talking about whether he thinks it's at the bottom. And it looks like for the most part, across most asset classes, other than still office is still trending down pretty well. Looks like most asset classes have kind of leveled off. They've come down since recent peaks. You could see what the change is recent peak. You can see the change in past 12 months. But for the most part, they all look like they've kind of leveled off. So that's optimistic for anyone who wants to think that we are at the bottom. We're buying at the bottom. You can usually never predict the bottom, but there's a pretty good indicator in a lot of metrics. That's where we are right now. So fingers crossed. Maybe Jay and I will do a apartment update, just like AJ did self-storage. I don't know. There's no one
that would be helpful because I know a lot of people are wanting to know that right now. Because I know in some markets where you have, because like you talked about too, Kyle, that inventory in multifamily it's a longer process. So You're seeing projects that are getting finished today that started 5 years ago. You're seeing downtown high rises, right? They're like, that started 5 years ago. I think a lot of people are wondering how that new supply and how the market.
Well, there was a lot of speculation too, because like there was all this news at the end of last year about all these apartment starts that are scheduled to come online in 2024, 2025, and we're just gonna have this massive scheduled online. But then like someone like Ashley points out, like a lot of those studies are based on permits, and just because people pull permits, like we talk about the threshold of when the don't pass go is, like permits are before that. So there would have been a lot of people who pulled permits on these things, and then interest rates shoot up, and you throw your numbers back in the spreadsheet, and all of a sudden they're not working anymore. If you're before that threshold, you're just going to say, okay, maybe we're going to hold off on this and wait a little bit. And so it'll be interesting. It seems like I don't want to ruin it, but it seems like it's not as bad as it was made out to be. So.
Well, I want to talk about that too, because I think there's something that a lot of people are forgetting that's different from other cycles that we've been in, and that is technology. And we should do a whole segment on this because the ability for you to get information today on a market and know how many units, who's building, where their loan's at, what the process is wild compared to what it was in 2007 or 8. A lot of times prior to 2015, you're guessing, like straight up just guessing. Like I think I go down to the county office and I'm like, they pulled permits. Are they building? Are they not? Can I get a hold of this person? And all of a sudden you find out that there's 2 buildings coming up you didn't even know about. Or, today with the activity, with the online capabilities, with governments going online, the software you have, it's wild how much data you can get on inventory and supply. And you would think that that would make markets more efficient, that people can make better choices because they have better information. And I wonder if that's one of the reasons why maybe the rise in interest rates have not hit certain asset classes nearly as hard as they would have in other cycles, because the data coming out, we have just more of it. And so we have more information on where markets sit.
Fair enough. Any final questions for AJ? He's kind of been on the hot seat here. We ready for a top 10, guys?
I think we should announce the winner of the mug.
Oh yeah.
Ooh,
forgot about that.
So yeah. So this is the beautiful prize here for anybody that's watching, a drunk real estate mug, and this will be the first one we are giving out to anybody that isn't a host or a guest host on the show. So this is a very special mug.
What number mug is this? Did you carve it in?
One of 17.
Oh, okay.
I'm making that up.
Small batch. It's like a bourbon. This is the small batch.
Small batch, exactly. And so the challenge was to pick or guess what the S&P was going to close at on as of today, starting last week. And so we had a whole bunch of people that participated. Some emailed me, a bunch put it on YouTube. And there was one person who came within, 14 points. So the S&P today closed at 5434 and a half, and 16 points, and he guessed 5450. So congratulations to Westward Russ on YouTube, who his name is Russ Weiss. And I actually know Russ because Russ is one of our investors. So I am thrilled.
So instead of giving Russ a mug, can we just like set up a like a hedge fund for him to run if he's got that kind of crystal ball?
If he wins the next one, we'll do another challenge like this. If he wins 2 in a row, then we'll hire him. But yeah, congratulations, Russ. I think I already have your information, but if you hear this, reach out to me. If I don't hear from you, I'll reach out to you and we will get you a mug. And thanks to everybody else that took a guess. We had a bunch of people that were within about 50 or 60 points, a few people that were a couple hundred off, but yeah, some close ones.
Now we got to try and get that mug autographed by all 4 of us, which is going to be really challenging. That should be like a master prize too. If you can get all 4 signatures on that mug, then there must be like another giveaway.
It'll be like when McDonald's does their Monopoly thing, and you try and get all the stickers to fill up the board. You get all our signatures.
But Kyle never goes anywhere, so it's like going to be impossible. I
told you I'm not buying a ticket to Limitless just to hang out. I don't pay just to hang out with you guys.
So if anybody that runs the Limitless conference is listening to this. If you want Kyle there, just offer him a free ticket.
I don't even want to go to watch the speakers. That's the thing. I just want to hang out outside of the speakers with you guys and stand there and chat.
No, you're not going to get anybody to give you a free ticket with that attitude.
That's fine.
I was thinking the same thing, Jay. I was like, well, forget about the free ticket. It's like...
But if you are, by the way, if you are going to Limitless, drop a comment because the 3 of us, except for Kyle, or as he likes to be known now, K-Wiz, making the pole vault, we'll be at Limitless, so you can come hang out with the 3 of us. We'll do the podcast.
Jay's got this thing now where he likes to put our little titles, and I don't notice it until right now.
It doesn't show. It doesn't show up on the video, so it's only for you guys.
Oh, okay. All right, top 10. I don't know about you guys, but closing ceremonies of the Olympics were on Sunday, and I'm a little sad. I loved it. It was something that was constantly on. There was always great stories. We talked a little about some of these stories that were going on. It's always just the good, wholesome news for the most part. There's some controversies that, we can get a little upset about, but for the most part, good, wholesome news, good change from, elections and assassination attempts and stuff like that. So I'm a little sad. So I thought I would make the next 2 things a farewell to the Olympics. And most people would say, let's do the top 10 medal counts, which America, yeah. But I got in a discussion the other day because I was in Canada about the fact that Canada per capita is actually much better than the US as far as medal count, which got me thinking, what's the top 10 medal count per capita countries? So I'm going to start out with number 10. We'll go through these real quick because some of them are just, I've never even heard of the one. So number 10, Georgia, they had 7 medals and 3.7 million people. So they
Georgia's a state.
Georgia, the country. It was the country that George Bush got.
Can you call them and see if they can find like 1,000 more medals?
Don't you remember we told this story? Actually, you guys weren't on that podcast. It was just me and AJ, where we talked about all the assassination attempts. And Georgia's where the guy lobbed a grenade on the stage to try and take out George Bush. So that was
you didn't get my Georgia joke, my political Georgia joke.
Wow.
Finding 1,000 more medals.
Oh yeah. Okay. I got you. Yeah. Go Trump. All right. Number 9. So this is the most impressive one on the list to me. Number 9 is Australia. They got 53 medals with only 27 million people. So that is 1 medal per 516,000 people. So for a country that big, usually the countries get bigger, they get less per capita. And then we have Hungary, Cape Verde, Jamaica, Bahrain. They are all in like the 400, 500, 1 per 400, 500 capita. New Zealand, right down there with Australia. They're just pumping out Summer Olympians. 20 medals with 5.3 million. So they had 1 medal per 266,000 people. And then finally we have St. Lucia. So these are kind of funny because St. Lucia had 2 medals. They only have a population of 185,000. So they had 1 medal per 92,000 people. It gets even better. Dominica had 1 medal. Their population is only 67,000. So obviously they have 1 medal per 67,000. And then number 1, Grenada had 2 medals with a population of 112,000. So that is one medal per 56,000 people. So think about that. If you 56,000, I could probably name 56,000 like between schools.
So at the risk of sounding grumpy, my issue with this whole medal count is that there's no way the gold medal and the bronze medal should be weighted equally. I mean, this is the only place where we celebrate like participation trophies. Like third place gets a freaking medal. You should do a top 10 where you reorganize the medals, where like gold gets 10 points, silver gets 5 points, and bronze gets 1 point or something like that. Because there's a huge difference between getting a gold medal versus getting a bronze medal. And I'll just shut up after that. But
on the official Olympic medal site, you can actually order it by gold. So there are some people who care about that. And so that was a fun fact. I don't know if you guys watched that, but we ended up tying. So US tied China, like right in the last day, 40-40 for total gold medals. And that was something that you could bet on betting sites. And there was a whole thing like people like, okay, how do you treat a tie on these betting sites? Because I guess they hadn't thought it through enough. But anyway, that was going back to last year. I think we beat China by 1. So it was back in Tokyo 2020 or 2021. It's called Tokyo 2020, but it actually happened in 2021. Anyway, that's the medal count. I thought we would get a little bit more because fun fact, if no one didn't notice that Russia, something going on there, they didn't enter the Olympics this year. So back in Tokyo, they had 71 medals that I thought, they would just get dispersed among the top people, but pretty evenly dispersed. Anyway, moving on to the game, another Olympics theme. My fun one. Have you guys seen the viral video going around about that girl from, I think she's from Australia, doing the breakdancing?
Oh yeah, the 0-pointer.
Yeah, it's one of the funniest things ever. And the fact that this is an Olympic sport. So anyway, breakdancing was added as an Olympic sport. And the host cities gets to kind of pick, adding sports and dropping
an Olympic event. It is not a sport. It's like golf. It is not a sport.
We're not going to get into that again. Anyway, so thankfully it's back in the US, LA next time, and LA decided to drop breakdancing. But I thought it would be fun that there's a couple sports that were added. This one in Tokyo. I was going to give an F, Marry, Kill for these 3 sports. And then I'm going to list the 3 sports that they're adding for LA. And I'll give you an F, Marry, Kill on those. So the ones that were just added were skateboarding, sport climbing, and breakdancing. So we know breakdancing's already gone. So I feel like that would be a front runner for the kill. But Jay, what do you got?
I'm not sure the context here, like what I want to do or what I think I would be best. Okay, you're not.
Use your brain, Jay. F, Marry, Kill. So F is something that'd be fun to watch once, but I don't think it should be forever in the Olympics.
Breakdancing, F. You got to marry skateboarding, and you got to kill the rock climbing. Kill breakdancing, F the rock climbing, marry the skateboarding.
There you go. That's a good answer.
I thought it was something I'd actually have to do. You're talking about just watching it. Okay. Yeah. Breakdancing is kill. I like the skateboarding. So that's going to be, I don't know. I don't know which way to go. I like that the best.
Got to marry that.
Well, then you marry that.
Yeah. I'm going to marry I really
the idea is you keep it around forever, Jay. It's
okay.
Not that hard.
Skateboarding and then F the sport climbing.
Mauricio.
What exactly is sport climbing, and how does that change from rock climbing?
Have you guys didn't see this?
They go up a wall. Really
it's about
quick.
5 seconds long, and so the point is that actually the one out for the gold medal ones. They were all about getting under 5 seconds was the thing, and they count down, and then these guys like spider monkey, like a spider on heroin, just all the way up the side of this wall, all the way up to the top in about 5 seconds. It's the fastest one up to the top to hit the button. It's it was cool to watch for like a little bit. So I'll preface this. I agree. I would marry the skateboarding. But I would actually probably F the breakdancing, because other than the awful ones, there was some cool ones that was fun to watch. The sport climbing just kind of got like, I couldn't tell like technique. Like usually most sports you could tell like, oh, that person's better than the next person. I couldn't tell in the sport climbing one person from the next why they were.
Out of all 3, breakdancing is hands down the least sport.
I'll agree with that. But I would say if I was going to spend one time watching a sport and then that's it, it's never in again. Breakdancing, it was interesting to see, I thought. All right. So next, in LA, they are adding cricket, flag football, and squash. So I would say these are a little bit more reasonable sports that they're adding, or not sports, if you events, as Jay wants to say. So between cricket, flag football, and squash, what do you think? Who's sticking around? Who's married? Who's getting effed? And who's gone? Who's killing?
I mean, squash is like I don't even know what squash really is. I think badminton. Squash.
I played squash. No, squash is like racquetball. It's racquetball with a long racket, like almost like a tennis racket with a really, or like the old school tennis rackets, the wooden rackets. It's kind of like that.
Yeah, the ball's just different. One ball's bouncy and big, and the other one's small and not bouncy.
Kind of like your. Oh, never mind.
What, Mauricio?
I'm going to kill squash. I'm going to marry flag football, and I will F cricket.
So did you guys know, by the way, that, I grew up in England, so cricket's a huge sport in England, but it's also, I just pulled it up, it's the second most popular sport in the world. So after soccer, which is obviously the most popular, cricket is number 2, but most of them are, they're usually all of the colonies of England. So cricket's really a British sport. And then think of all the countries that it colonized back in the day. So Pakistan, India, Sri Lanka.
It's very popular in the Asian countries too, right?
Yeah, because when Great Britain colonized the whole world or whatever part of the world, they just introduced cricket. But cricket's the second most. So and I used to play cricket myself, so I'm definitely marrying cricket. I'm gonna F flag football because that's fun. Squash, I've played squash because it's also a big sport in England. I was going to add snooker is another it's actually more popular than volleyball in the world. Snooker's like billiards, and I'm surprised that's not on the list of Olympic events.
And Jay would call it an event, not a sport, then, right?
Oh, no.
Snooker's by the way, snooker is so much more fun than pool. Like pool is so boring where you just kind of get whatever, half the balls in, striped or thing. But snooker is actually it's a pretty fun one because it's got points and there's a strategy behind it as opposed to pool, just like whatever.
Straight pool. Straight pool is a sport.
Is it opposed to non-straight pool?
Meaning like
AJ, what's your pick? We've already lost AJ. AJ's on Instagram right now.
I'm like, listen, the moment we started talking about squash, I'm like.
So AJ's killing squash. Got it.
Killing squash just because of the name. That alone. Right? Like, come on. Cricket, the Brits, they play that, but they sit around and have crackers and tea. So cares about that. Then the other one is what was it?
Flag football.
Flag football. Listen, it's the wussy version of football, but it's football. So
I'm going the other way. I'm saying it's not football. Flag football is not football. Flag football is what you play to warm up.
But you have squash and cricket.
Yeah, but okay, I agree. It's not like I'm a huge fan of squash, but like squash, like all these other rackets, we already have badminton in the Olympics. Like, why does badminton deserve to be in there more than squash? So I agree with everyone. You marry cricket. I think cricket. The biggest argument against cricket is like you're not like the cricket World Cup's going to be bigger than the Olympics, but so like why have a sport in the Olympics if it's not like the epitome of the sport? But
like basketball, you mean like basketball?
Yeah, I agree with that too. Well, I mean, I guess the argument there though is that there's no other way that countries get together to play against other countries. Like at least in cricket, they have other countries.
You could create a world league.
You could, but I don't think it's nearly as popular.
I mean, half of those sports is not the most important one. It's like anyway.
Okay, so anybody that's gotten this far, just make a comment down below if you're watching this on YouTube. Is golf a sport? Yes or no? Yes or no?
Yes. Golf is a sport.
It is not, but I want to hear what other people think.
If you watch what Scotty Scheffler has done this year and try to call him not an athlete,
what's the definition of a sport? I mean, what is the definition of a sport?
I don't know.
Because like auto racing is a sport.
That doesn't narrow it down. I've been shit-faced playing hockey before. Like, is that not a sport?
That makes it more of a sport.
Fill up the water bottles with booze on the bench. All right, let's wrap this up while Jay's looking up the definition of a sport. AJ, you got a plug for us?
You know what? I plugged the book so much. I'm definitely not going to talk about Growing Wealth and Self-Storage 2.0 on Amazon. So, instead, I think I will plug the AJ Osborne podcast. Check that out.
Thought maybe you'd plug like a new Porsche that you picked up. Isn't that why you couldn't come last week? Because you were buying a Porsche or something?
Yeah, Porsche threw a party, and so I was at that, and it was awesome.
Must be good if you're speechless and don't want to go any further. Mauricio, what do you got? Plugs?
I'm gonna we had a great podcast today. So Real Estate Syndicate Alive. It's a live pod every Tuesday. I moved it to Tuesdays, 11:30. Real Estate Syndicate Alive. I'm gonna do a special because it's timely. I'm gonna release Jay's podcast this week. So check it out. It'll be on my YouTube channel. But come to realestatesyndicatelive.com. We get to talk to people live. It's a blast.
Because by next week, everything Jay said will be wrong. Jay, you got the plug.
we had dozens of people there. We were answering questions. It was fun. We were not drinking, unfortunately. I'm gonna plug AJ's book, and so Self-Storage 2.0. I'm gonna plug Mauricio's book. Strategies,
legal strategy for everyone.
Legal strategies for everyone. I'm going to plug Real Estate Syndicator Live. I'm going to plug
Bad Ash Investor.
Kyle Wilson. I love you guys. Get all the plugs.
I don't want any plugs.
I don't think you should allow. Are you going to allow Jay to plug Ashley?
Jay, did you see what Mauricio did last week? So last week before this podcast, Mauricio was like, Kyle, like, do you just not want to be tagged anymore in this? I'm like, no, stop tagging me. Tag like our company or like something else, like, or tag Ashley, tag my wife. She's got 20-some thousand followers. Like, if you want to like promote so she can repost it, like tag her, don't tag me. And he's like, okay, I got you. No worries. I'm done. The guy goes the next day and he does a Instagram story where he's like, hey, my buddy Kyle, he's all upset that no one ever comes to his page. No one ever tags him in anything. So I want to help him out. Here's a link below. Everyone, please click on this and please go check out his page and go say hi to him. It will make him feel so great. So like Ashley showed me this. I'm like, this guy. Like,
did people actually? I have like 5 followers, so I can't imagine that many people tagged you on it.
I see. I don't know because I'm private and like so people if you want to.
So they couldn't do it anyways.
Yeah,
so.
exactly.
You sent them to somewhere where they couldn't even.
And actually, so I found out when I was playing hockey, like if you deny someone's friend request, then they just request you again. So what I ended up doing is I just leave them pending, right? So I have like at least 1,000 pending friend requests. And so like when people are like, oh, you didn't accept me, I'm like I got to search through my friend request to go and find and accept you. So anyway, yeah, I'm not an Instagram guy. Lurker.
Here we go. I am going to do a plug. Now that you mentioned that, I have 1,000 pending friend requests on Facebook. If you want me to accept your friend request, because I'm almost out of space, if you've listened this far, send me a message telling me that you heard this. I will accept your friend request.
Such an exclusive group.
It doesn't take much.
I'm not accepting any at all.
All right, let's wrap this up. Anything else, guys? I think we're good for the day. We ended up making it into a decent length episode. We didn't think it was going to last very long. Yeah, and Mauricio, you got to finish that up. I want to see one last drink, Mauricio. Let's go. Nice. You and I are the only ones drinking, so I can't even tell the other guys. But my drink is gone. I got to hit the head. AJ, are you back in the country next week or what?
I am.
Oh, that'll be nice. We get to see Ernie again. It's just not the same without him.
Exactly. I miss it.
Actually.
All right. My drink's gone. I'm going to go hit the head. So I'll see you next Tuesday.
See ya.
Late.
See you guys.